Hello, are you worried about inheritance tax? Would you like to keep control of your assets and pass them to your loved ones without them facing a tax bill of up to 40%? Then investing in an inheritance tax portfolio could be a relatively simple and flexible way to protect your assets from IHT. You retain complete control of your investments, and if you wish, you can even draw an income from them. Once you've held the portfolio for just 2 years, it could be passed on to your heirs or anyone you choose, free of IHT on your death. Inheritance tax portfolios work by investing in companies that qualify for business relief, often known as business property relief, or BPR in short. This tax relief was first introduced in 1976 so that family businesses could be passed down through generations free of IHT. Since 1996, the scope of the relief has been widened. Today, anyone can benefit. If you have shares, no matter how many, in a company that qualifies for BPR, you could pass them on with no IHT to pay. Whether your shares are worth £1,000 or £1 million, if you've held them for at least 2 years and still hold them on death, current rules mean you can pass them on free of IHT. If your circumstances change and you want some of that money, you can normally make withdrawals, although of course the amount you withdraw will no longer be IHT free. Remember, tax rules can change and the value of tax benefits depends on circumstances. So how can you invest in BPR qualifying companies? You could pick and choose your own shares to build your own portfolio. However, many prefer to leave that to a professional asset manager. Generally speaking, your portfolio will be made up exclusively either of AIM stocks or unquoted trading companies, both of which qualify for BPR. AIM portfolios are generally ISA eligible, which means you could transfer your existing ISAs to one and make them potentially IHT free. Unquoted companies can be many things. Portfolios typically include asset-backed businesses such as care homes and pubs. Some invest in renewable energy projects such as solar or wind farms. Others, instead of investing, may lend money, often against a property, either for development purposes or as a bridging loan. So what are the risks? IHT portfolios are investments. They're normally managed with cash preservation as a priority and aim for a modicum of growth. But there are no guarantees. The value could fall as well as rise, so you could get back less than you invest. Capital is at risk. In addition, the companies you invest in may be smaller, newer, or subject to less stringent checks and regulations compared to a fully listed business. Inevitably, this carries extra risks, so BPR investments are not for everyone. You retain control of your assets and can access them if need be. However, AIM and unquoted shares are typically less liquid than those listed on a main stock exchange, so it will normally take longer to liquidate your portfolio. Some products only allow 6-monthly access, for example. And please remember, tax rules can change and the availability of BPR will require portfolio companies to maintain their qualifying status. Should they lose it, IHT relief would be lost too. That said, for those comfortable with investing and the risks, IHT portfolios can be a great way to pass more of your assets to your family. Unlike many other forms of inheritance tax planning, you retain control of the investments. If you want to draw an income from them, you can, or if you ever need to cash them in completely, you can.